Hi everyone, welcome to another module of Mindfulness and Money. Today we have a very special guest with us, and when we want to talk about serious stuff, Megan is the one we call. So I'm very excited to have you here, Megan, because I know that you have such deep knowledge but also experience, having spent years on Bay Street, but you have an art in the way you explain things so that they can be simple for us to understand and engage in.
Thank you for having me. I'm actually really excited. I think sometimes when I get to talk about technical things or things that are new for people, I do get quite excited because for me, it's about showing somebody that they have the capacity to do all these things. That some things that might have scary titles or scary terms associated with them have nothing to do with anything scary. In fact, when we kind of unpack most things, we find something quite simple sitting in the box and we just didn't know about it. And so I'm really excited for today.
I want to just insert a gentle reminder here to remind you to tune into your body and breathe deeply as you hear these different topics, because we are really going over a lot of things here and it may not necessarily make sense for you right away, especially if you're hearing these concepts for the first time, and that is okay. The more you hear them, the more easier they will become, and sooner rather than later, these terminologies will just become second nature to you. So take a deep breath. I know it could be a lot, but we're here with you every step of the way. So let's start talking about the basic instruments that everybody hears about all the time: stocks, bonds, indexes. So what are all those? And let's start maybe with stocks. How would you explain what stocks are for people?
Absolutely. So stocks is definitely one of the more common things people hear about. And when you hear the word stocks, equity, shares, you can kind of collect them all into the same sort of thing. And what they are is ownership of a company that's gone public. So it's not for any company on the planet. It's companies that have decided to go public. So they're usually medium to very large size companies. And when you're buying into them, what you have in the end is a little ownership of that very large company.
Okay, so then what are bonds?
So bonds is the other side of that company. It's actually the debt of the company. And some people are like, wow, debt, why would I? We're always told debt isn't always the best thing. But for companies, debt fuels their growth. It's something that they need to grow and expand. And when there's a bond, as the investor, you're actually creating the pool of money that the company needs to loan. So those types of investments tend to have different features of them, but you're basically loaning the company debt, like a bank would normally do, and you get to participate in that when they pay it off.
Mm-hmm. So stocks and bonds are terminologies we hear often, but indexes is not as much. So how would you explain what that means for people?
Sure, well, an index, and this is outside of the capital markets as well, an index is a unit of measurement. So what happens when we're looking at the capital markets, we're looking at investing, an index is a collection of things used to measure. Some of the measurements that we see, the really big ones, the Dow Jones Industrial Average, the S&P 500, they're measuring big parts of the economy from the public markets. And they're saying, okay, what did all of these large US companies do? The S&P 500 generally tells us. Some of the indices are a bit smaller. There's indices for the Canadian banks. So you can find out, oh, how well have the public Canadian banks done recently? And so it's a unit of measurement. And they're used both to see how it's done and also to compare how something has done compared to it. So a large company like Apple, you could say, how is Apple done compared to the whole market? So it's a great tool of measurement.
Perfect. To summarize what you said quickly, stocks is when you own shares in a public company, bonds is when you buy debt for a company, and index is basically a unit of measurement to measure a specific industry and how that industry is performing. Sounds about right.
Sounds great to me.
Okay, so now let's go a bit deeper and now talk about funds. So how do you explain a mutual fund?
Sure, so a mutual fund is something that has some active participation from fund managers where they go out and depending on what their focus is, it could be energy companies, it could be technology companies, it could be international companies, and they go out and they pick all the ones that they think would make up a great portfolio for a person to invest in. And so they go out and they collect those for them. And they're great tools for people to get some of the diversification that they want.
And I used to be a financial planner, as you know, so a lot of the times the fund name itself gives you an indication of what's in that fund. So you can buy a mutual fund that's called like an energy fund. So a lot of that fund would be in the energy sector. Or you can buy a balanced fund, and that gives you an idea of how much risk you're also taking, which is something we'll talk about in a bit. Explain the term ETF on its own, and then let's talk about it being in a fund.
Sure. So an exchange traded fund is a little bit like a mutual fund where somebody's, put the pieces together for you in some way. The diversity you see actually within the number of ETFs out there is very large as well. There's ETFs that are very sort of plain vanilla, and not in a bad way. I actually like vanilla ice cream, but they're plain vanilla in the sense of that it's a collection that tracks something else, kind of like the index, where it might be equally rated across all of the Canadian banks. And so you're getting an ETF that's just tracking those, and so there is somebody who's decided to put it together, but it's not necessarily a lot of changes that are happening throughout that process. What's unique to an ETF compared to a mutual fund is how you purchase it. Is you actually can go on to an online account and purchase it one day. You could sell it the next week. It's very easy to buy and sell.
So Megan, we talked about mutual funds and we talked about ETFs, but it's also important to explain what index funds is, because that's a terminology that isn't usually intuitive for people to understand. What is an index fund?
So an index fund is a financial product that you can purchase that is based off of those indexes that we talked about that measure different areas of where the market's growing or shrinking from the public companies. And so what happens is you can buy a ready-made fund that already has that diversity that you might be looking for. So you can buy a fund that tracks the S&P 500. You can buy a fund that tracks the Canadian banking sector. Index funds I find great because they do have some lower fees attached to them compared to other investments. And they also are nice because those, as the indices updates, so does that fund. So you're kind of getting that rebalancing that can occur on an annual or a quarterly basis, and it's already being done.
Mm-hmm. Now, let's get into the concept of active versus passive investing. Because when we talk about ETFs and mutual funds and stocks and bonds, most people don't understand how active or passive these vehicles are. And the misconception here, and I've had clients who also misunderstood this point, active and passive investment is not about how engaged you are with your investment. It's more to do with the investment itself. So let's clarify what that is for the listeners.
When you're looking at active management, that's where there's a team of investment people and they're making those decisions. They're always kind of updating and changing, and they have sort of investment thesis that they think is going to do great in the market for the next number of months, number of quarters, number of years. When you're looking at passive, that's where they've either kind of the set it and forget it, we're doing 6 even between these banks and you're going to own these Canadian banks, or they'll track one of those index funds that we talked about where they're just going to match what something else is doing. So they just lay out what it is and then they leave it alone.
Mm-hmm. So index funds are passive funds while mutual funds are active funds. And based on how active or passive your personal investment plan is, that determines the fee structure associated with it. So it's really important to know there's always a fee associated with investments, but the fee structure varies very much so depending on how active or passive your investments are. Because like you said, when you're active, there's more research, there's more people involved in making decisions. But when you're passively invested, you're just selecting a unit of measurement or an index that you're following, and there's less work involved in that.
Mm-hmm, exactly. And that's where I think a little bit of kind of our elementary school math we should all start using when we're looking at where those fees come in. If something has passive management and it's matching, one of the big indices like the S&P 500, and there's less than 1% of fees, let's say the S&P returned 8% that year, you've got 1% of fees, you're looking at 7% total gain. If you had an active manager do that, you would have your return, but then the fee gets taken off as well. So you have to see if it's a couple of percent, that's great. There are some out there with much greater fees than that, and you have to make sure that you're getting great value with what you're doing. And there are some great fund managers out there that do provide that value.
Absolutely. And my invitation for anybody always is to check your statements, understand what are you invested in, what are the fees that you're paying, and evaluate these things consistently, at least once a year. But if more, that would be ideal to do it at least quarterly, I would say is a good frequency, just to kind of make sure that you're on track, that you have the right strategies implemented. And that's what professionals are there for. So we talked about different products. Now let's talk about the accounts that these products usually sit in. And that's also a very big misconception, because having an account in itself is not an investing, because you can have cash in that account. But let's start with a tax-free savings account.
So a tax-free savings account is a program that the government has. I personally think they're terrific, because although when you put money into it, you don't immediately get any tax advantage, all of the gains that you have in that account are all tax-free. And I think that's terrific. And also because there's no tax advantage going in, if you were to take money out, so let's say you're using it maybe to save for a house, you don't have to use all of that account just to save for 50 years down the road when you retire. You can use it for other mechanisms. And it's a great way to minimize on those taxes. It can add up to a lot.
Of course, so it's important to actually insert here a point that you do pay taxes on your investments. So before we even talk about the tax savings, it's important to acknowledge there are taxes to begin with, that if you are putting investments in a non-registered account, which is just an investment account, then all these holdings are subjected to tax. So it's important that when you have room in your tax-free, which is determined by your age, because you can start contributing to your tax-free when you turn 18, that room continuously grows with you and is forever available. So the first place you want to maximize is tax efficient places so that you can make the most out of your investments. And that's really important to understand. But there's another account that can also have a tax advantage to it, very different than tax-free, the Rrsp. So what is an Rrsp, Megan?
So an RSP is another way that we do save on taxes. So when you've got the investments made in there, it does grow tax-free, kind of similar to the TFSA. What's different about it is that the money that you put in has an immediate tax advantage. How much that impacts you depends on your current income, but most people do see some immediate benefit to putting money in. And then at the end, so once you're all ready to retire, that money gets taken out. There are some tax considerations at the other end. So it does function differently to the TFSA. I would say they're both about planning. Most people, in my view, should have both accounts in some capacity. And when we look at the third account, then non-registered, there's a lot of people that do need 3 accounts. But for the most part, I would say at least 2 of the 3 is good for most people.
Absolutely. And when you have a specific amount of savings at the end of the year, the famous question I always hear is like, where do I put it? Tax-free or Rrsp? So it's really great that you brought that point, because it most likely is a hybrid solution between both. And that's because our goals are spread throughout the years. You have short-term goals, you have medium-term goals, and you have long-term goals. And having awareness and understanding of what these goals are helps us be disciplined and stick to the investment strategies that we need to do, which is something that we should always revisit and evaluate as we go. I would actually insert an analogy here just to kind of make sure it's sinking in for everybody. So imagine you're going into a store and you have the shopping cart, and then you're buying items from the shelf. So the shopping cart itself is the account. That's the Rrsp or the tax-free. It's the account that then when you're putting the products from the shelf, these are then the stocks or the bonds or the mutual funds that are going inside the cart. Would you say that's a fair analogy?
That's a terrific analogy. I think when we are looking at terms and we're trying to help people understand terms, anytime you see the word account, think of that shopping cart. Think it's a container, it's something I'm putting something in. When we see the word account, something's going in it. It's not your actual investment. That's the container that you need, the cart that you need to get moving.
The other important thing to mention is diversification. And diversification is not so much about buying something from one bank and then going to another bank and buying something else. Because you can go to one bank and buy an apple and then go to the other bank and buy an apple. And now you have 2 apples and you think you're diversified just because you bought them from 2 different institutions. When in reality, the word diversification is not putting your eggs in one basket and making sure that your holdings are across different sectors and across different risks depending on your goals, like we said earlier. So you can go to the same institution, buy an apple and buy an orange, and now you're more diversified than buying 2 apples in 2 different places. So that's another thing that I also found individuals misunderstand how to diversify, and it's more to do with what you're buying, not where you're buying it from.
Absolutely. I think from diversification too, sometimes there's people who, especially right now in the media, we hear a lot about, oh, there's this one stock that everybody's talking about. It's this one company that everyone wants to own a piece of. And for somebody who's just starting out, it might seem like, oh, I have to go out and buy that one company. My advice is, unless you can allocate, if you already have an investment account going, it might be an option for you. If you don't, find the index that has that company and buy that as an index fund, because then you're still owning it. So if Microsoft, happens to hit the news, they're a big part of the S&P 500. You can easily buy an index fund that tracks that. And then guess what? Now you own Microsoft. Yeah. And it's a great way to participate in that without taking on too much risk.
Especially because a lot of us don't necessarily have either the time, the interest, or the knowledge. I would always tell my clients you need all three elements to invest properly based on facts and not emotion. And that takes a lot of time. So buying indexes and funds are usually not just a safer, but a more feasible way for the average investor. Let's talk more about retirement savings.
Great. Well, Asil, I think it's really important that we start to discuss not just our own personal investment areas, but also the different parts of our lives that contribute to our long-term financial investing future. One of them is actually a national program, the Canada Pension Plan. And for people's knowledge, what a pension is a pension is a way that we take often forced savings and over a number of years that transforms into income when we retire.
And I really want to emphasize the word forced savings because it's happening without even you knowing. And that's because every paycheck you get, there's a CPP deduction on it. So it's important that you kind of glance over that and understand what this item is. It's not just something that's been taken out of your paycheck for nothing. It's the government supporting your retirement planning for later. Now, one of the myths that I really want to address about that is a lot of misconception in our society are from people who believe that the CPP is just bankrupt. And the reality is that that is not the case, because at one point CPP was an in and out fund. So people were simply contributing into it, the working force that is, and then retirees would take a percentage of that out. And because our society is an aging society, there were more people taking out than people putting in. So if that was the trajectory we were going to continue on, then eventually the fund will definitely run out of money. But in 1997, CPP established an investment fund, which now allows this fund to continuously grow in order to fund our retirement without jeopardizing our future. So that's something really important to know. And the other thing additional to that, some people may misunderstand that the government actually takes this money to fund other projects like infrastructure or like any projects the government needs, and that's absolutely not the case. These funds are mandated to simply be overseen by an arm's length of the government, and somebody else is overseeing them, and they're strictly used for our retirement. So it's important to know that. And the last point I want to make is really trying to emphasize that even though this is forced saving, it's just one of the many vehicles available for you, and it's not enough, because at best it will fund about a third of your retirement for the average person, that is. So depending on your retirement goals and lifestyle needs, you absolutely need other vehicles, and that's why it's important to engage with a financial planner and advisor and use the other vehicles available for you, whether it's a tax-free savings account we talked about, the Rrsp as well, and the employer pension plan. So you mentioned earlier that we have employer pension plans available. So what are some of those things that you can share with people so they can understand how to make the most out of that?
Absolutely. With respect to people's employment options, when it comes to different benefits that can happen towards your retirement and towards savings, I would say there's as many plans as there are types of employment out there. So it's a very big spectrum. There are a number of careers that people go into where there is that pension plan that mirrors a lot kind of like what the CPP is doing, where there's forced savings that's all about your retirement at the end.
So let's get real for a second. There's two words that usually scare people away from this conversation of investing in general, and that's fees and risk. Let's talk about risk first, because that's a really misunderstood topic. And by risk, when the word is used, a lot of people just tune out from that point onwards thinking, nope, it's not for me. I'm a risk-averse person and I would definitely not risk my money. But let's talk about why this is actually counterintuitive, because by avoiding investing, it's even more risky than being involved in some sort of risk in investments. So why is that?
I think what happens is when people think about investing risk, they always think about those really high risk situations that happen. It does happen in the markets. There are some market participants that do engage in that type of behavior. As a whole, that's not actually where most of the investment risk is and should happen for most people. There's a lot of great medium risk opportunities for investors to take on themselves. And what happens is when you do some really calculated medium risk decisions over time, that ends up in a great situation in the end. So medium risk, although it sounds a little bit scary, is a great place for most people to be. What happens when we look at the low risk and the no risk situations, those are actually areas of caution for most investors, especially young investors. The low risk areas can work if you're looking at something that's very short term. Maybe you're trying to save up a down payment, you know you're purchasing a house in 3 to 4 months or something like that. But for the most part, that low risk isn't going to get you to your goals, and it's actually on the edge of danger to no risk, which has a big problem with it. When you're looking at some of the guaranteed investments that you can purchase, they're actually returning below the level of inflation, which means although it does show a return, you're not even keeping pace with inflation. So over time, you're actually losing your money, which is the same as what happens with the high risk groups that people are doing up there. So although no risk might sound appealing, I think you're just as risky long-term as you are with the high risk, which is you're losing all of your money. So medium risk is actually a very comfortable place for most investors.
Now that we talked about risk and you mentioned the word inflation, let's explain what that is, because that really emphasizes why taking risk is important, because there's inflation and that is happening anyway. So we need to beat inflation to even start making money. So what's inflation?
Sure. So inflation is what happens from the economy as, you know, the economy is growing and changing. And that's basically the principle that something today is going to cost a little bit more tomorrow.
So inflation right now in Canada is about 2%. That means your money loses 2% of its value year over year. So if your money is sitting in cash or sitting in investments that aren't yielding a higher percentage than 2, your money's basically losing value along the way. And that's why investing is important, because you want to be able to exceed the 2% return in order to just keep up with inflation, and then exceed higher than that to just make sure that your long-term goals are being funded as well. There's a level of volatility involved in the market. Explain volatility, but also help individuals manage their emotions around it, because that's one of the biggest risk pitfalls that we fall into, is when we start acting based on our emotions.
Sure. So volatility is any big price swing that happens in the market, and that's within a short amount of time. You see the market go up a lot or down a lot. Definitely any move in the short term that's 10% would be considered a lot, and that's looking back at those indices that we talked about, how much that they're moving. And what's important to look at is sometimes the markets can have volatility across the board, like with the pandemic or the financial crisis over a decade ago. Those were definitely situations where the whole market became very volatile. When you're looking though at what often happens is there's sector volatility. And it's important to notice and to check your emotions to say, okay, is this the whole market doing something, or is this a sector doing something? And again, the next level of volatility is, what do I own and how is this affecting me? So if you are investing in the broad-based markets through index funds or ETFs or a mutual fund where you own just a lot of everything, a lot of market volatility is something to make note of. If a market goes down a lot, sometimes buying into those broad-based funds can be a good strategy. But if you own a sector or if you own an individual stock, that volatility can have a greater impact on you, and you really need to know what you own and is this volatility affecting whether you should own it or not.
Now, the second thing that we talked about that usually scare people off from this conversation is the word fees. And what's important to know is that you're always gonna pay for the value that you get, and there's different values and options available for you depending on your needs. So there's the do-it-yourself options, which means you have your own self-directed accounts and you're the one taking responsibility of making these calls of what to buy, when to buy it, when to sell it, but it's much lower than if you were to be dealing with an advisor and delegating that task to someone else entirely. But there's also something in the middle, which is the Robo Advisor, and that word has been gaining a lot of traction recently. So let's explain what Robo Advisor is.
Absolutely. So I think Robo Advisors are great innovations that have happened within the investing space because they give you an easy access online way to engage with investing, kind of like the do-it-yourself model, but there's a bit more information that you provide into their systems, which kind of sort of puts some boundaries on what you're seeing and what you're doing. So it just presents to you what might be investments that are great for you to choose from. And also there are opportunities to reach out to somebody for advice along the way if you need it. So again, it's a little bit in the middle, and I think it can work for a lot of people, especially if your investing profile isn't yet quite complex in terms of your needs. If you're starting out or you're anywhere under $50,000 to $75,000 from an investment fund, a Robo Advisor, because of the fee structure, can be great for a lot of investors.
Absolutely. So know what you buy, know why you're buying it, and know how much it's costing you. So it's important to have an awareness on all these different answers. So there's different ways in which you make money when you invest. And some people buy investments and say, okay, now what? How does this grow? So let's break this down and explain the different ways in which investments grow. The first is the capital gains. So capital gains is basically the difference between your selling price and your purchase price. So if you buy something today for $10 and you sell it in the future for $15, then you've made $5 capital gain on that specific investing. But there's different income streams along the way, Megan, so help us understand what are dividends and interest rates, because these are also other ways in which you make money with investments.
Certainly, yeah. There's income streams that come with different types of investments. You have income streams from a dividend that might be paid when you purchase the equity of a company, or there's also the interest payment that comes with, sometimes there's different titles to it, but that comes with the bond that you were to buy. So if you're loaning that company the money for their growth, then you get that interest payment. So if you do, say, a $200 investment, and it might be paying you annually the $10 over time, for the length of the investment, you get that $10, and then usually you get your $200 back at the end. That's a standard type of income stream that you could expect to have. And there's also a third type of investment where you get both. And often with dividend paying stocks, that's very common, where you're purchasing the stock for the dividend, but also having an expectation that it will grow over time. It's important to note that that's where we can kind of see risk.
So let's talk about some tips. But before we do that, it's really important that you know there's never going to be one size fit all, and it's always useful to seek the help of individuals, particularly because you have unique situations and there are different strategies that apply to your unique situations that your professionals can be able to advise you on. But these are tips that could be general guidelines for the average person. So what are some of the tips you would leave the listeners?
One tip I would look at is one piece of advice that you'll often hear, and I do agree with to a certain extent, is that if you've got something broad-based in the market, like an index fund for the S&P 500 or something of that nature where it covers and encompasses a lot of companies, when there's high market volatility and the markets are down a lot, that can be a good place to buy for a long-term investor. So if you usually put $1,000 into your investment portfolio every quarter, maybe that month, if you're able to swing it, doing $1,500 could even work. Over time, the likelihood that that will come back up to where it was and higher is really great. So that's kind of a buying opportunity. I would say though that if you own an individual stock or something that's very sector specific and that is down 20 or 30%, I would not apply that advice because that is very specific to why is that sector down.
So we shared a lot today. And we need to acknowledge that these are not things that may sink in right away, and that's okay. These conversations sometimes takes weeks, months, or even years for us to fully understand how they work. And that's why there's lots of support network around you, whether it's your own advisors, whether it's the books and the courses that you can take, such as this one, whether it's the friends that you can surround yourself with that have this mentality of constantly wanting to educate themselves and commit to wealth creation and healing and building a relationship with money, which is really what conscious economics stands for. Regardless where you are falling on the spectrum, what's important is we'll leave you with the fact that starting today is better than just not doing anything about this at all just because you're feeling overwhelmed or really trying to avoid a topic that causes you uncomfortable emotion. So my invitation to anybody who tuned in today and listened to this module is to listen to it again and again. It's always here for you. We've recorded this episode and you can come and play it again and again until these jargons and concepts start making sense for you. What are some of the things you would like to leave our listeners with?
I'd love them to know that sometimes starting is the hardest thing, but once you've got the investment accounts and you've got a few investments going, you actually feel better. You don't feel more lost. You don't feel more confused. It does feel better. Your knowledge starts to grow.
Yes.
And by taking these little steps, in 5 years, you're going to be in a great place. You're going to give every dollar you have a job.
Yes.
And once your dollars start earning money for you, you're going to feel pretty good about yourself, and you should, but it starts with that first step.
Yes, it reminded me of that quote, do something today that your future self will thank you for. So you did it. You just listened to this module. Now go and apply what you learned.